KDKR's daily programming do not necessarily reflect the views of the management or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, is indexing always the answer? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, you know the drill. Just go to prudentmoney.com. There is a section called the Ask Bob section. Send it in. Love to get your questions. Love to get your comments. And that is a great way for you to get information. That's off the website, www.prudentmoney.com. I also want to remind you that we do have a newsletter list that you can sign up for, and you'll get sent to your inbox everything that we post on the Prudent Money Radio Show, including a weekend summary of our podcast that we produce Monday through Friday. They're of the program, so if you miss something, you can always listen to it at your leisure. You can find the Prudent Money podcast at literally any of your favorite platforms that you listen to podcasts on, and just Google or search Prudent Money, and we should come up. You can also listen to it at the site as well. So that's all those resources are there for you at prudentmoney.com. We'll start off with the market. You know, we went through this period of time. I mean, this last month was not a bad month, looking like it was over. The death to the bear market, as we might say. And, of course, if you turned on any financial media, you're starting to see the articles that, well, the bottom of the bear market that started in January of this year is over. What should you do now? Well, here's the thing about bear markets is that they get people to thinking that they're over, as they not necessarily because they are over, but because they are taking a break. If you look at historically, the way bear markets play out is that they go down into a decline, like they did starting in January this year. Then they rebound, and they look like, oh gosh, glad that's over with. But then that rally or when they go up stops, and then they start going down again, and they get all the way down to another low point, and they start to rebound again. People think, oh, it's over with, and then they start going down again. I hate to be the bearer of bad news, and it's just literally, this is historically has been the pattern more times than not. So they can be somewhat tricky. I think that's what we're seeing today is the market taking a break and then starting to go back down again. The reason why we had such a big up day in the market last week was because of the Jerome Powell coming out saying that, well, it looks like we're going to be more conservative on raising interest rates. Interest rates are the problem because as you know, what the Federal Reserve Board is doing is they are fighting inflation by raising interest rates. The whole idea is to slow the economy down, which in turn will slow inflation down. That's what it means in theory. Now, you know, if you listen to me, and we've talked about this many times, that it's not, I don't think it's going to work out that kind of cut and dry, as the textbooks would say, or economic theory would say. I think that there's a whole type of part of inflation that is not affected necessarily as effectively by rising interest rates. The problem is that you're not seeing the economy slow down, and you're not seeing employment slow down. Last Friday, we saw employment come out, strong number again. That's been the case all year long. So what that does is that tells the markets, well, we need more medicine, please, from the Federal Reserve Board, which means more raising interest rates. And the thing is that the Federal Reserve Board can afford to raise interest rates if things look and appear to be strong. Now, you know as well as I do that these numbers, the potential of these numbers being creatively put together, we'll say it that way, is with the government, as you know, can be the case. So I don't think that employment is nearly as strong as it is. And I think if they continue to raise rates, they'll ultimately get what they want, but how far down will the economy have to go to do that? But let's go back to employment statistics real quick. So we have a strong employment, so the numbers say, but why are business owners so eager to hire in a situation where inflation, the numbers say that, the indicators say that inflation has gone down over the past 3 months? Do you believe that? Do you believe that inflation is 7% or so? I don't believe it. I go to the grocery store like you go to the grocery store, and we are spending way more than a 7% raise. And in other areas, we're spending way more than 7%. So I see that an economy that they are creating the optics that, yes, it is taking off, it's strong. You hear it from the president, you hear it from political leaders. The market doesn't like that. I think what you have to look at inflation is, does it still having a big impact on life? I know that when I went to the grocery store the other day, I spent $30 to $40, probably $45 more than I should have. And it's not like I bought a bunch of extra stuff. To me, the impact is still there. You're not really seeing the impact of energy costs, which they're trying to keep that low and that's a whole nother story. But why business owners are looking at this whole scenario and going, hey, makes sense to be hiring way more people, I don't buy that. I don't buy that at all. I think all this demonstrates that there is a real problem. I wrote an article, a letter, like I always do to my clients, stating that nothing adds up. Nothing adds up. And then you have the scenario where we've had 2 quarters of negative economic growth this year, which is the definition of a recession. Oh, but it's not a recession. Yeah, sure, we called it a recession in the past because that's the definition, but this is not the definition this time. This time it's different. I mean, the whole world has gone mad. So if I had to guess, this is starting to show back up in the markets, and I think it's going to show up in the market in a big way. This is why the entire time, even last year when it didn't make sense to be saying it, I still said it, know your risk level, understand your risk level, and be comfortable with your risk level. If you're not comfortable with your risk level, then get it to a place where you are comfortable with it. Any advisor can help you do this. Any advisor that is not just trying to sell you something, any advisor that is a technician can help you with this. You just got to make sure you're choosing the right advisor. So this is your opportunity, I think, while things are up a little bit, to make some of those changes. No, you're not trying to time the market, as Pop Culture Finance would say. You're just trying to reduce risk. So if you've got any questions about that at all, please go to the website, prudentmoney.com, send it in to the Ask Bob section, and I will get you taken care of. I didn't quite finish the other day, I guess it was yesterday, about fees and that are being charged. When is it okay? When is it that you should question fees? So we got into it, but I want to continue down this path because I think it's important information. Dear Bob, I have a firm that is managing my 401k plan and charging a fee for it. How do I know I am getting something for the fees that I am paying for? there is a difference, and I do believe yesterday I read this sentence and we talked a little bit about it, but I didn't really get into what I wanted to. But I think a lot of people do this, and I think that it makes sense to go back over it. I've never really liked the whole idea, and bias alert, by the way. I've never liked the idea of charging of a company using a financial advisor or a planning firm to charge fees for money management when there's not a whole lot of money management that can be done in a 401k plan. I don't object to the process of charging, to the concept of charging fees. What I've seen is that they're charging higher fees than they should be for what the 401k employee is getting. That is somewhat my issue with it. One thing that I think that you could do that makes even more sense is utilize your own financial advisor if you have one. I believe that that's part of the holistic responsibility of what a financial advisor is supposed to do. If a financial advisor is managing your retirement plans outside of your 401k plan, they should include the 401k plan at no cost. And they should be there as a resource to do that. And make sure that you're set up to look and match what you're doing on the outside of your 401k plan. If that's not the case, if you don't have that kind of situation, then I would pay an advisor 2 or 3 times a year just for an hour's worth of work to look at your 401k plan and make suggestions. I think you'll come out a lot cheaper and get a little bit more personalized service. Just a thought. Hey, this is Bob Brooks. We are coming up against a break. Stick around. You won't want to miss our next section. We'll be right back.
The Word for Today is excited to announce the new official online home for the ministry of Pastor Chuck Smith and Kay Smith, PastorChuck.org. At PastorChuck.org, you'll have instant access to thousands of hours of verse-by-verse teaching by Pastor Chuck Smith from Genesis through Revelation, and full access to special messages on subjects such as prophecy and much, much more. Also at PastorChuck.org, a full library of great teachings by Kay Smith, and a section where you can read some of Pastor Chuck's books online, all free of charge. So visit the new official online home of the Word for Today and the ministry of Pastor Chuck and Kay Smith, PastorChuck.org.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
Dr. Charles Stanley.
Christmas is the celebration of that moment in time when God came to earth in the person of His beloved Son, Jesus, in order to reconcile sinful men unto Himself by His substitutionary death on the cross.
In Touch with Dr. Charles Stanley, helping you grow in Christ every day.
Listen daily at 12:30 on Bible School Radio 91.3.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you have a question for me, please go to the website, www.prudentmoney.com, and I will get it answered for you. That's off the website, www.prudentmoney.com. In fees in general, there's really 3 types of fees. The first fee are planning and advising fees, generally charged by the hour, varies from firm to firm, varies from advisor to advisor. That's your first fee. Your second fee is what the investments themselves charge, which is, you really don't see those fees. They're built into everything, so it's just kind of there. And then the third fee is what the advisor charges to manage retirement plans or manage financial accounts. and that varies as well. One of the things that I would have you consider is that before you sit down with a fee-based investment advisor, make sure you know what the going rate is, because you want to make sure you're not being charged too aggressively fees. So let's talk about those fees, though, that are built into the mutual funds. And we'll use mutual funds as an example, because it gets into the argument of index funds versus actively managed funds. And the difference between the two are fees. Your fees are higher in actively managed funds. Now, anytime I talk about this, I typically get an earful from somebody through Ask Bob telling me how I'm wrong. Well, first of all, I'm not trying to be right about this. This is just my opinion. Second, I believe that there is a place for index funds, and I believe there's a place for actively managed funds. I also believe that there are situations where indexing is absolutely superior to actively managed funds. So it really would be hard to argue a point with me because I'm kind of all over the board. But let me explain. First of all, let's talk about what an index fund is, just in the event that you don't have a good idea of what one is and what it does. An index fund is a mutual fund that mimics an index. It's a passive fund. So an index would be like the S&P 500, the stock market index, what we would generally call the S&P 500 index fund. So that fund goes up and down with the S&P 500, which is generally looked upon as the stock market. Or you could have it follow the Dow Jones Industrial Average. You could have it follow NASDAQ. Whatever market that you want it to follow, you can buy an index fund for that. So the expenses on that are hardly nothing because it's just passive and there's nothing to manage it because it just does whatever the market does. That's the first thing that you need to know. The second thing is an actively managed fund, which is managed by a money manager. That has much higher fees on it. And you're paying for their ability to manage those investments, buying and selling stocks, that kind of thing. Now, when would you use index funds? When would you not use index funds? Now, please hear what I'm saying. I think it totally makes sense. You would use index funds if you're trying to get market returns because they're following the market, right? Makes sense. You would use index funds if you had a risk level that was congruent with the market. So you're willing to always take market risk. So if that's the case, then you would put it in an index fund, and you would definitely pay the lowest fees because it would make sense. Now, let's say when you would not use an index fund is when your risk level, in my opinion, is much, much, much lower than the stock market. If you said if a 10, 1 out of 10, if 10 was total 100% market risk, which would be an index fund, and you were a 5, I would not suggest that you add index funds to your portfolio because that risk that you're taking, that market risk, is much higher at a 10 than it is at a 5. Hope that makes sense. Another time I would use an index fund versus an actively managed fund is if you told me, Bob, I have this actively managed fund. It is set up to beat the market. Well, statistically speaking, actively managed funds that are trying to take the same amount of risk as the market, trying to beat the market, trying to be better than the market, the probability, according to statistics, of that happening is much lower than than the fund actually beating the market. Statistics say it's a very, very low probability that you're going to pick an actively managed fund that's going to do better than an index fund. So I would rather not take the chance. I would rather go with the index fund because my probabilities are better that they're going to be right there with the market versus they're not going to beat the market, shouldn't beat the market. And an actively managed fund who's set to beat the market probably is not going to beat the market either. The bigger problem is, and I don't know what the percentage is, but the large percentage of stock-based funds, mutual funds, that are available are trying to beat the market. And so I would use an index fund. Now, if you go back to, hey, my interest rate, my risk is much lower than the market, there are also a percentage of mutual funds that manage for risk, and they don't lose the kind of money that index funds would lose. They've shown that in history. They show to be a lot more conservative and to manage for risk and to manage for loss and growth. And you got to pay a little bit higher of a fee. So you look at that and go, is it worth the fee? Absolutely. In my opinion, if they are doing what they said they're going to do, then it would be worth the fee. The indexing crowd would still argue with you, which I don't get the basis of that the index fund would still be the better choice, some combination of them for risk, because the fee is lower. So let me ask you a question. If we go through a bear market and your index fund, which is tied to the S&P 500, loses 50% of your money, and the actively managed fund that is managed for risk, that's conservatively based, lost 15% of your money, do you think you're going to care about that extra 1% or so of expenses that you're paying? 15% loss versus 50% loss. So that's my opinion of how it works, and you can form your own opinion, your own judgment, obviously. But I do believe that the index funds are superior to those actively managed funds that are trying to beat the market. Let's wrap up here real quick and talk about when I don't think that it makes sense for advisors to charge fees. I don't think that it makes sense for an opinion. So the potential investor comes to an advisor and says, this is what I'm doing. What do you think? Do you think I should change? I think that that's an opportunity for the advisor to demonstrate what they know, their expertise, demonstrate another option, and I don't think you charge a fee for that, for an opinion. If the person goes, well, I want the advisor to charge a fee I want a new plan, a retirement plan, then that's when I think it's okay to charge a reasonable fee. Once again, you also don't want to pay for a bunch of planning that you're never going to use. So I've seen people that just really would pay about an hour and a half of an advisor's time, and versus 5 hours to put this big, ginormous book together. So you can be the judge of that. Target date funds, I think this is absolutely ridiculous that mutual fund companies like a Fidelity would charge a commission for an advisor to sell a target date funds when there is no management to it. If you buy into the target date funds, if you like it, it's a buy, invest, and you leave it alone. That's what they advertise, and that's the way they are set up. I've never believed that those should be a commission-based fund. I've always thought they should be a non-commission-based fund, because if that's your intent to invest into a target date fund, and you really believe in it, then you put your money in to let it do its thing. So there's a couple of things about fees. I know regulators are really big on fees right now. The new fiduciary standard is part of that. And I think the regulators are doing some good things to make sure that the public is protected against higher fees, that inappropriate, unsuitable fees. How about that? Hey, this is Bob Brooks. You got a question for me? Please go to the website at prudentmoney.com and send it in, because we are all out of time till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.